Thanks, CA Study Circle, Vasai branch. Thanks, dignitaries on the dais, Sunil sir and others for giving me this opportunity to be in front of you. I'm planning to cover my presentation within next 40 to 45 minutes. Couple of slides which will be data heavy, probably we'll skip that and you will get the presentation. I'll request coordinators to forward it to you. Balance 15 minutes, probably we'll try to have more and more interaction. So any questions, I'll be glad to clarify that. So let me start with mutual funds. It's as it said since morning, it's an opportunity, ocean of opportunity, and I 100% agree with that. As we'll take it to the further discussion. Various investment options. Historically, as Sunil sir also mentioned, gold, property, fixed income, that's fixed deposits with banks. These three are the largest ones till couple of years back, and now gradually, following probably demand, things are changing and changing for good because it's a diversification that helps. And one of the product, insurance, I consider more as a risk management product rather than the investment product. While investing, there could be two different perspectives. One perspective could be to make a return out of it, and second could be growth or the appreciation. So one which is generating regular cash flow, regular income, could be corporate fixed deposits, your postal schemes, your PPF, and a couple of other fixed income products. But one which will grow over a period of time in terms of value, and which could be relatively volatile in the short term, could be property, gold, art collection, equity shares. So while investing, one has to keep in mind what exactly one is getting into, what is the objective of investing. And then it would make sense to decide which investment product one wants to get into. So for making investment decisions, there are 6 factors which I like to categorize as. People try to look at only return. मुझे क्या मिल रहा है? कितनी mileage दे रही है? Typical Maruti advertisement. Rather than mileage, rather than return, one has to look at risk, and that is much more important than the other 5 parameters. Risk could be price risk, it could be credit risk, it could be inflation risk, it could be reinvestment risk. One has to understand risk, and now with efforts of SEBI, riskometer that goes in all mutual fund products, and it's still not going in other products, be it PMS and AIF, probably other even direct stocks would be difficult to put it as on a riskometer basis. But one has to look at which part of the risk I'm taking and what quantum of risk I'm taking. In finance world, it's easy to calculate risk by calculating standard deviation. But there are many other risks one needs to understand, and specifically the credit risk when one is investing into fixed income. I know a couple of my clients who have invested into fixed income products assuming that 100 rupee will come back. The challenge is all 100 rupee doesn't come back if it's a default risk, right? Credit risk. In price risk, when you are taking, be it in the fixed income product or be it in the equity product, you are taking only 5, 10, 20% of risk. But when you are taking a credit risk, it's 100% risk. So keep that in mind while investing into any financial products. Second factor to consider while making investment decision is the return. Obviously, one wants to see their wealth or portfolio growing, and unfortunately, people try to maximize return while not knowing that it's the period, how long you hold on, that drives the return. So if you look at the formula, future value is equal to present value into 1 plus R raised to N. Most of us have studied this not only in CA curriculum but also during college curriculum. But the factor over here is most important is the N and not R. Because R, you can stretch it to a certain extent, but not beyond that. N is under your control. R is not under your control. A product which is giving fixed return, it will stop it over there. Product which is giving variable return like equity, You cannot start expecting every year to make 30, 40, 50%. Once in a while you could be lucky, but it will not be over longer term. And that's where one has to stretch and rather than trying to think about R. So that's where return factor is important. Third factor which is most important is time horizon. I've seen people investing into equities with very short term horizon, and when your trading call goes wrong, you ultimately becomes an investor. So that's problem. While before making investment decisions, one has not looked at what kind of time horizon I have it. So when markets are good, time horizon gets shrunk. One wants to be trader, but when market timing is bad, when markets are bad, time horizon reduces, and then rather one gets extended and one becomes a real long term. So trader becomes a long term investor. That's unnecessary accident that happens because one has not understood clearly what my time horizon is before investing. So get out of recency bias, focus on what my cash flow is allowing me to take a particular risk and then get into particular investment product. Third factor to be considered is the liquidity. In any market, and we have seen it in fixed income more so, when things turn bad, liquidity evaporates. So while constructing your portfolio, consider liquidity factor. Even while getting into mid and small cap stocks, which we always like to get into, when markets start with the correction, liquidity evaporates. So one has to consider what kind of liquidity one needs and then match it with the product profile. Fifth one is the taxability, which I'm sure you're good at, and I'll not practicing taxation, so I'll not be right person to comment on that, but nevertheless, one has to consider the taxation, certain products, and which I'll be showcasing in last couple of slides, how one can improve the post-tax return even within fixed income space rather than just remaining invested in a traditional product. And sixth one, the last aspect which one needs to consider before making investment decision is the regulatory aspects. If you are US-based NRI, there is a concept called PFIC, Passive Foreign Investment Company, which makes very difficult which makes difficult and increases burden to keep on reporting to Indian agency and to US agency whatever investment you would have done it. So from that perspective, from the PFIC perspective, investment in mutual fund becomes difficult for US based investor compared to probably direct stocks. So, and there could be multiple angles when I'm saying regulatory aspects, even succession laws. When investor himself is or herself is not there, how it passes through, whether when first holder is not there, whether the same portion goes to their legal heads or the second holder becomes the first holder. Those aspects, unless you are clear with, it becomes difficult or it results into some accidents in future dates. So better clarify on these 6 aspects before you make any financial investments. So why mutual funds, and not only mutual funds, why any investment? These are the 4 principles which will help in making your decisions right. One is a principle of compounding, the another one is principle of diversification, third one is principle of rebalancing, and the last one and most important one is the start early and avoid timing. So we'll touch upon a couple of these factors in our presentation later. Power of compounding, and as Albert Einstein had mentioned, that compound interest is the 8th wonder of the world. He who understands it earns it, and one who doesn't understand pays for it. So basically, compounding, as we in a common parlance know, as a interest on interest. But it's not only interest, it's the overall return. And when you keep your investment as it is without dilution in terms of paying a tax, it grows over a period of time. So that's where equity gives you better return, or rather one of the component why equity gives you better return compared to fixed income. What exactly is mutual fund? Mutual fund is basically a trust. It's a pool of account under the structure of trust, and that's where the fiduciary responsibility lies with trustees, where all investors are pulling together funds Fund manager manages it based on the mandate decided under offer documents. So as this chart shows, investor pull their money, goes into fund scheme. Fund manager invests in various securities, which could be fixed income and equity related or even commodity related securities, which generates return over a period of time, and that return goes back to investor that is meant for investors. So it's basically pulling of assets together in a vehicle, and through that vehicle someone is managing it, who is the fund manager. Largely advantages for investing into mutual funds vis-a-vis couple of other financial products. It improves your convenience, it's much more cost efficient. Thanks to SEBI, which has been constantly improving various regulations to cut down the expense ratio. And to best of my knowledge, the expense ratio and the all governance related that is much more stricter in India compared to many other developed countries. I've seen many products globally with entry load and exit load as well. So your 100 rupee starts with only 95 or 97. It never starts with 100 rupee. Thanks to SEBI's changes since 1994 on mutual fund regulations, where our 100 rupee starts with 100 rupee in any of these financial products, be it a mutual fund or any other product for that purpose. Liquidity, thanks to once again SEBI norms, mutual funds have relatively quite better liquidity, almost 100% I can say. And when I compare this with whatever happened during 2007 and 8, where a couple of mutual fund schemes were locked down for even redemptions, where there was a restriction of a cap on withdrawals. I think those issues are now history. With SEBI taking many measures, liquidity has improved a lot. And it's now standard format. If it's liquid fund, T+1, tomorrow you'll get back money. It's equity fund, T+3. So, and that's working very well. So in the last couple of years, I've seen very robust processes around that. And still, this will further get reduced from T+3 to something lower as and when SEBI announces that. Tax efficient. Couple of besides ELSS, which is called ETC schemes or ELSS, equity linked savings schemes, there are other tax advantages also, so which we'll discuss on later slides. It's definitely diversification is one of the advantage of investing into mutual funds. On an average, you'll find at least 60 to 70 stocks under any mutual fund scheme, unless it's focused one. Focus would have a maximum 30 stocks underlying in the scheme. It's run by professionals. There is always a research team and a fund management team. If it's a fixed income, then credit research team and fund management team. And besides that, dealers and others, which works in as a team, and they perform. All performance is much more in a public domain, so everyone focuses on improving their performance constantly. It's very much transparent. If one looks at history of mutual funds, 1964 to 87, we had only one mutual fund, UTI. Like LIC for insurance, UTI was enacted under UTI Act, and UTI was enacted under Act, and they were the basically vehicle to kind of collect savings from the investors, which ultimately got channelized to corporates for kind of for their expansion plans, and so it was more like a kind of vehicle to bring savings together and put into expansion or future growth of country. Second phase, after UTI reached something like 6,700 crore of AUM, that's where the second non-UTI mutual fund was launched, which was SBI Mutual Fund, and that was once again backed by a couple of institutions. It was still, SEBI had not come into picture by then. In fact, after that, SEBI came and multiple private sector, it was opened up to private sector. So there were only two mutual fund houses at that point of time, prior to SEBI coming into picture. As soon as SEBI came into picture in 92, between 92 to 94, there were many regulations which started coming out related to be it PMS or to related to mutual funds, or related to even stock markets, stock brokers and others. So that's where private sector was opened up for mutual funds, setting up the mutual funds. Gradually, the number had gone up to 33 from 93. And Kothari Pioneer was the one which was among the first among the private sector mutual fund, which got finally sold out and got renamed, merged with Franklin Templeton. The fourth phase was 2003 to 2011, where a couple of mergers, consolidation, amalgamation happened among the mutual funds. There was something called Lotus Mutual Fund, there was something called ANZ Mutual Fund, ANZ Greenlays, and then Stanchart Mutual Fund, Morgan Stanley Mutual Fund, couple of names which got consolidated, bought out by others. So it had reduced from 33 to 28 numbers. But once again, it started expanding. At this moment, there are almost 44 mutual funds, fund houses. It's still much lower compared to the country of our size. I'm sure this number will grow as we look into future. In US, there are probably more than 800 mutual fund houses, and each of the mutual funds will have a few hundreds of mutual fund schemes. So there would be plethora of mutual fund schemes for one to look at, and then one needs to decide which one fits into my profile before I start investing into it. So the 2011 to 2013, many measures were taken to improve the governance performance of mutual funds, and I see benefits of that on regular basis now. So during from 2014 till now, look at the growth. It was 10 trillion, now it's 40 trillion. It's expanded like anything. One of the factor probably was, or rather multiple factors, but one of the factor was demon of 2016. But other factors which I'll give more weightage to would be technology upgradation. As technology expanded, as it became more and more technology driven, becomes easy to handle volume. And I can relate the same with stockbroking community. Stockbrokers, where it was an outcry system in Ring prior to 94, there was 15 days or 30 days settlement period. In fact, multiple times you had objections, bad delivery. Nowadays, it has reduced significantly. The auction system also is probably not as in terms of percentage compared to total volume is not as big as what bad delivery and objection volume used to be earlier, and which was creating bad test for the investor. When one needs money, it was not available because of bad delivery, objection, or whatever. So with technology, it has improved a lot, and same applies to mutual funds. Mutual funds also has become much more efficient in terms of processes. Various milestones mentioned over here in mutual fund industry. As I had mentioned, entry load has been removed. There is a number of platforms for investment which have come up. There is an institute called NISM, National Institute of Securities Market. I'll suggest if someone wants to study, please look at that. Many courses they carry out. It's backed by SEBI and very much updated courses, so could be good for the next generation who is looking at getting educated within capital market. Introduction of direct plans, probably many would not be aware of. Last couple of years, there is something called regular plan, there is something called direct plan. In regular plan, brokerage or commission is being paid to the agent or distributors. Under direct plan, where expense ratio is lower, so your return could be higher, no commission is being paid to the any intermediary. So that's once again very interesting development or regulation by SEBI. Advisor and distributor segregation since 2013, caps on expense ratio, and which has been reviewed multiple times, and it has been reduced significantly. No upfront commission because there is no entry load. Earlier it used to be entry load, and most of the advisors, bankers or brokers were interested in churning portfolio because they were making entry load, and because of that upfront commission. Now there is no upfront commission. Introduction of systematic investment plan, and which has become extremely helpful vehicle for retail investors, and we'll discuss and look at numbers also over there. Tightened inter-scheme transfer norms, which improves once again governance of the mutual fund performance, mutual fund operations. Riskometer label, which I was mentioning about, that riskometer defines what kind of risk you are taking while investing into a particular mutual fund scheme. And dividend option, which I find many investors having wrong or rather misconception about dividend. Unlike in stocks where you are getting dividend as a separate dividend compared to your stock price, in mutual fund dividend is paid out of your own stock price. So it's same NAV, out of which if they are paying you dividend, it's adjusted right after that. So it's your own money which is coming back. So dividend option within mutual fund is basically you are diluting your future compounding. So that's where dividend options has now been renamed rightly so by SEBI. It's called IC income distribution, IDCW, income distribution and capital withdrawal. So which basically means that your own money is coming back. It's a capital withdrawal for you. So wanted to clarify that. And norms to bring in more and more transparency in debt securities transactions post Franklin Templeton fiasco. What happened? So let's look at growth of mutual fund industry. As I was mentioning, size has grown significantly, and there are still only 44 fund houses. Compared to that, more than 800 in USA. So we have a long way to go. And penetration in B and C or top tier 2 and tier 3 cities is still very much lower than what is there in tier 1, and much lower compared to the global standards. So definitely there is a huge scope to pick up in terms of mutual fund penetration for the country. Recently, SEBI has allowed mutual funds to invest in commodities. So gradually you'll find a couple of commodity related mutual funds also coming into play. Right now, we have only gold and recently silver related mutual funds being launched. Over a period of time, you'll see many more as SEBI allows that. But prima facie, they have allowed commodity mutual funds. And there is always focus on the corporate governance. There used to be some kind of arbitrage people used to play within liquid fund through the lead trading practices. That has also been curbed. So many things have happened for good. So one of the vehicle we were discussing about SIP. SIP is just one vehicle. There could be two other ways to invest into mutual fund. It could be STP, it could be lump sum. So right now, SIP has become more like a glimmer word. People like to get associated with SIP, but ultimately it's one of the vehicle to invest into mutual funds. Thanks to Demon, where monthly SIP was around 4,000 to 5,000 crore, and now it has touched 13,000 crore. Number of folios which took till April 16 to reach to just 1 crore mark, and now it's almost 6 crore mark. So look at the participation, number of SIP which have gone up, which basically shows the retail participation. And to best of my knowledge, average ticket size in SIP would be somewhere around 3,000 rupee. It will not be very high. So that itself shows how retail participation is increasing, and rightly so, because direct stocks are not meant for retail investor. Let's accept that. One cannot study companies so thoroughly to start taking investment calls. Here someone is doing on your behalf, which is a fund manager, and for that he is charging the expense ratio, which is much more transparent and as per SEBI norms. So it's much more regulated. This is the graph which shows post-demon how your SIP has grown, and this is where, despite massive sell-off by FIs in probably exactly a year back, while all global markets, all global emerging markets show the good correction, India was still holding on, and we are still closer to the all-time high levels, thanks to this SIP. Size of mutual fund industry, it has grown significantly. It's almost closer to 40 trillion, which is 40 lakh crore rupee. It's partly it has taken up bank term deposits market share, but still there is a long way to go. As I see, there is a still potential for everyone to participate in mutual fund and grow their wealth. When I'm saying in mutual funds, let's not have a misconception that I'm only referring to equity mutual funds. No, there are many categories, and then we'll discuss that also. So look at the size. Definitely PMS and AF are the next one which have started growing, but mutual funds by far is the largest one in the capital market segment. Retirement, which is pension, it's also growing. So most of the provident fund and pension funds of corporates, they are counted over here. And historically, people used to have a insurance or considering insurance as an investment product, but now people are realizing that it's a risk product and better treated as a risk product and rather than mixing with the investment. So on the basis of structure, it could be open-ended mutual fund, it could be closed-ended mutual funds. Open-ended has an advantage that you can get in, get out any point of time. Closed-ended will generally close their subscription within a time frame. After that, they'll not accept new money, and they'll redeem by whatever design they have it at the time of launch. So in fact, couple of closed-ended funds, when they mature, they give an option also to investor if they want to roll over to another scheme, by which you can retain your tax benefit of long-term capital gain, which is 36 months for debt mutual fund, and equity would be around 12 months, long-term, short-term breakup. So when rollover happens, it becomes kind of advantageous to the investor. So type of mutual funds, as I was mentioning, it could be categorized under three buckets, which SEBI also is now doing the same since 2018, where a couple of categories are equity schemes, couple of debt, and a blend of both would be hybrid. So for which kind of investor it's suitable, I just briefly mentioned. Basically, as you know, equity remains a higher risk compared to the other ones. So within equity, there are almost 12 different categories, or it could be little more than that because a few sector and thematic I have not considered over here. But now it's much more well defined. So you'll not find so it's true to its label. That is the concept of SEBI now. Whatever you call it, it should reflect what strategy underlying it would have it. So you can't say XYZ large cap fund and having strategy of mid cap or small cap within that. And that's where now it's very much true to its label as a category. There are almost, so everywhere it's well defined. And on a regular basis, auditor needs to check that and provide the report to the trustees about whether category labels are being properly kind of followed or not. So it could be, I'll just read out the names, probably details you'll find it in the presentation later on. For the benefit of time, I'll just go through that. Large cap funds, it could be mid cap, it could be large and mid cap, it could be small cap, it could be flexi cap. Flexi cap category has been recently, probably just 2-3 years back, it has come into picture. Earlier it was considered as a flexi and multi cap together, but now SEBI has defined it very clearly that flexi cap would be one where fund manager has a full freedom to invest into any equity, but equity by definition, all equity schemes need to have a 65% into domestic equity at any point of time. So flexi cap is full flexibility to the fund houses. Focus fund, as I said, maximum 30 number of stocks. Multi-cap, I'm just jumping into multi-cap, where now they've segregated as a category, where at any point of time it would have 25% into large cap, mid cap, small cap separately, and further 25% the fund manager would have a flexibility. So that's where SEBI has redefined and kept both categories separately. And other categories could be dividend yield, value, contra, sectoral thematic, and ELSS for the tax saving. The point of defining this category is that you can have only one scheme of a particular fund house out of one category. So you cannot have from say Birla Mutual Fund house, you cannot have a two large cap. There were earlier was a time when people were having two large caps from the same fund house. And like any salesman, any mutual fund house will showcase to you whichever is performing better to get more money. So SEBI has made it very clear that per category only one fund scheme. Out of debt mutual funds, based on the duration and based on the credit risk what you are taking, so it could be duration risk, it could be credit risk. They've redefined the categories. So it could be overnight funds, which is the lowest in the terms of duration. Then goes liquid fund, and then it will keep on improving ultra short duration and low duration, money market, and so on and so forth. I hope he's fine. Fine. So I'll just proceed with debt mutual funds. Other debt mutual funds could be long duration corporate bond, and every way it's very well defined in terms of what they will invest into, what could be maximum limit, and so on and so forth. The third category, where it's a blend of equity and fixed income, there are within that also many subcategories, and there also it's very well defined. So I think there are a couple of funds which people invest into without knowing why they are investing into that. So as a general suggestion or as a general proposition, the way we work is, if investor is investing in equity for the first time, for them to get used to, we'll start with hybrid funds, which would be something like equity savings, which could be larger debt and little bit of equity, around 25-30% into equity, balance would be fixed income. When they are used to volatility, then further we increase the equity component, and we move to balance or balance advantage. And for the seasoned investor, then we get into all equity schemes. So that's where these hybrid funds help. But if you are doing allocation yourself in terms of debt and equity, there is hardly any requirement to get into equity rather hybrid schemes per se. Arbitrage funds, one of the best substitute compared to your savings bank account. Money is available anytime, definitely after 1 month of exit load, and it's a T+3. So once you know that you'll need money in after 3, 4, 5 days, then it becomes easy to invest into arbitrage fund. But it gives better return, considering that taxation is better in arbitrage fund compared to your traditional fixed income products. So arbitrage fund has its own space in the client portfolios. And in arbitrage fund, it's all hedge position. There is no naked position. 100 rupee of your equity is covered by your short futures. So at any point of time, there is no naked position. And despite that, it's considered as an equity, and that's where the tax advantage vis-a-vis traditional fixed income products. There are gradually there is a tendency among the developed markets. People are moving more and more from actively managed funds to passively managed funds, and we also see a trend over here where more and more passive funds or index funds are emerging. More and more intelligent or smart indices are being launched by NSE and their companies, and BSE and their index management companies. So more and more indices are being launched. You can have a more and more ETF or fund of fund hooked onto those indices, and they will perform continuously in that particular space. So there could be large cap index, there could be mid cap index, there could be small cap index. Same way you can have a index pertaining to particular sector, say IT index, you can have a FMCG index, and one can start creating funds based on those indices. The advantage over there is when you are directly investing based on the underlying index, the fund manager time is reduced a lot, and accordingly the expense ratio gets reduced quite a bit. So a low cost participation in equity market can happen through index fund, and most of these indices are rebalanced or reviewed every quarter or every 6 months. More often it's 6 months. So when it's reviewed, automatically something is performing, will have a more probability of coming into index and automatically into in your portfolio. So to outperform index becomes much more difficult, and same is experience in developed market and gradually over here as well. So that's where index fund you'll find as a passive investment strategy coming up or growing in a big way gradually in India. So just to put it in perspective of risk and return, which becomes easy for investor to know where exactly they are getting into. On one axis is risk, another axis is return. And as you see in the debt market, debt space, moving from overnight to liquid to ultra short term to short, and then so on and so forth, where your duration is increasing, automatically your risk is increasing based on the duration. Credit risk fund also can fit into any space between short term to hybrid. So duration could be somewhere beyond 2 to 3 years, but one has to be little cautious. As I said, credit has high risk component attached to it. On equity also, while perennially they are much kind of riskier compared to fixed income, but as it progresses from large cap to sector driven, risk definitely increases further. So how to invest in mutual funds? It could be online, it could be offline. Traditional way was offline, and as I was mentioning, thanks to technology, various technology platforms, volume has picked up significantly. And you've seen it, that 10 lakh crore, which is 10 trillion going to 40 trillion as an industry size, thanks to these technology platforms. So there are various websites, almost all mutual funds, they allow a transaction through their own websites based on a particular process. Same way, most of the mutual fund distributors will have their own websites, but at back end, they could have probably developed their own process, or they would have hooked on to something like BSE platform, NSE platform, or MF utility platform. So these are the three platforms, BSE, NSE, and MF utility, which are available to distributors for their for hooking onto their transaction platform aggregation. So MF utility is owned by all mutual funds together, and they allow participation through their member mutual funds. So as I was mentioning, SIP is only one vehicle. There are other two vehicles, STP and lump sum. Generally, we advise investor to do in a systematic way, because no one knows market, whether it's a top or it can further go up, whether the correction has happened or it can further correct. No one knows that. Let's be honest about it. And in that process, investing systematically, that helps. Investor could be salaried person who knows his cash flow every month very well. Part of salary which he uses for household expenses can keep it aside, and out of balance amount he can invest through SIP. But someone like a businessman or a professional who doesn't know cash flow, or who doesn't have a steady cash flow every month, for them STP is better. So within systematic transfer plan, what happens is money gets into liquid fund, which yields something like minimum around 3% going up to 6.5% based on the interest rate movement. Right now it's around 5.5-6% in liquid funds. So it's a liquid fund is just the intermittent platform. From there it goes into equity funds. So assume it, you are salaried class, you are getting regular salary. Out of your salary, money goes into your equity funds. Ultimately, one is trying to time entry into equity funds through these three channels. When you don't have a regular salary, when you are a professional or a businessman, then if you have X amount at this moment, you park into liquid fund. And from liquid fund, you try to spread out your buying in next 6 months to 12 months or 18 months. Based on whatever your perception is or expectation is, that next cash flow will come in. So if you have X amount today and you are expecting that you will get Y amount after 6 months, you spread out your investment out of X divided by 6 into next 6 months. When you get Y amount, you once again look at what next cash flow whenever you are going to get, and try to divide your Y amount and spread it over a number of months. So that is the way STP will work. It's very open architecture. You decide your frequency, you decide your amount, what you want to spread it out, and you can invest. Generally, any mutual fund scheme will have a between 500 to 1000 rupee as a minimum investment amount. So it's much more lower and much more affordable from that perspective. SWP, systematic withdrawal plan, like SIP and STP, where you are investing, as name suggests, SWP means you are taking out your money from the mutual fund investments. This is one of the best tax planning or tax saving tool from the investment perspective. Rather than withdrawing money full together, you spread it out in such a way that your impact on the capital gain tax is much lower. So just to give you an example, if you invest into bank FD and get the interest on a quarterly basis or monthly basis, first of all, when you go for monthly, your return drops. If you move to say quarterly or half yearly or annual interval, your cash flow will get stretched to that extent. And definitely return will be little better. But instead of that, you invest into certain fixed income schemes or saving schemes which will have some equity component, where you, over a period of time, you build up your buffer in terms of return. And then you start with your SWP. The withdrawal amount will get taxed only to the extent of capital gain built into it, because whatever you are withdrawing, larger portion will go against your principal amount. Only small portion will go against your capital gain amount, which will be chargeable. And based on that, your taxation will apply. So some calculation, what we had done it was showing something like, and first of all, after 3 years, it becomes long-term capital gain. So the long-term capital gain will have a 20% with indexation in fixed income instruments or debt mutual fund schemes. So what happens is, first year, your tax would be something like 3 to 4% will increase to something like 7-8% and maybe 10% in third year. Post third year, once again your tax rate will drop to 7-8% of your SWP amount, because of 20% taxation with indexation. So considering inflation, it will be somewhere around 7 to 8%. So this is one of the good useful tool to plan out your cash flow requirement along with the tax saving thinking. SIP and STP, how it benefits? It benefits because of the cost averaging. When you are buying say HDFC Bank or Reliance shares every month out of your savings, virtually tendency is to buy number of shares, right? 1 share, 5 shares, 10 shares, 100 shares, whatever, every month. And you continue doing that just to build up your holding into good quality blue chip stocks. In that, the only disadvantage is that when price goes up, still you are buying 1 share. And that increases burden on you. When prices are dropping, you are still buying 1 share, so you are not taking advantage of it. In mutual funds, when you are deciding on the value, it's a value averaging that is happening. So when price goes up, as you look at it in the rising market columns, number of units will drop. So what happens is, as market goes up, you are buying lesser number of units. You are buying lesser quantity. And on the other side, when prices drop, you are buying more and more quantity. So you are taking advantage of market correction. You are buying more when prices are dropping. You are buying less when prices are going up. So that helps when you look at, even if market is stable at same level, still you will be probably in profit if your fund selection is good. Many times I get a question whether to, when do I sell? Market has moved up, can I sell? And so forth. No one knows, let's accept that. No one knows what the market is, whether it's at the higher level or it can further go up. Whether it's a lower, it can still further correct. No one knows about it, and I don't pretend to know that as well. So rebalancing is the one tool which helps in terms of selling high and buying low. Theoretically, everyone wants to sell high and buy low, but only this particular mechanism will help you in managing that as well. So first one needs to decide on what could be my allocation between debt and equity, and then keep on rebalancing to the same number every year, or as and when you think your proportion has gone out of way. So just to give an example, starting point could be say 50-50. strategic asset allocation, SAA, strategic asset allocation between debt and equity, 50-50. Assume it market moved up. You have 50-50 moved to 60-40. You need to rebalance. You need to go back to 50-50. So you take out 10% out of your equity and move to debt. What you are doing is basically selling high. Assume it market goes down next year and drops and your allocation moves to 40-60. 40 equity, 60 debt. At that point of time, one needs to do rebalancing again. By rebalancing at the lower level, you are selling debt and buying equity. So you are buying equity at low level, you are selling equity at high level. It's inbuilt mechanism to do the profit booking, but that doesn't mean that even after you've done profit booking, market cannot go up. It can still very well go up, but balance amount, whatever your strategic allocation was, that much you are participating even if it goes up further high. So this is the, rather than asking anyone whether I should sell it, whether I should do profit booking, my holdings have gone up, don't ask anyone. No one knows about it. Just sit down and look at your allocation. Whatever allocation you started with, just go back to and rebalance and go back to that. That itself will help you in getting better results rather than asking anyone. Taxation, probably you know much better than what I know. Equity with 12-month cutoff and debt with 36 months cutoff between long term, short term. Equity, short term is 15%, long term is 10%. Definitely over and above that, whatever surcharge and cess would be. Fixed income, slab wise if it's short term, and 20% with indexation if it's a long term. So rather than Franklin mutual funds fiasco, let's move to the selection process. So what are the critical factors and what factors we consider, how we try to select a particular fund? One and most important is Sharpe ratio, which basically means that risk adjusted return, which means that whatever performance, be it 3 years or 5 years, whatever number I'm taking, I reduce it by the risk-free rate, which is government paper yield for the same time, and divide it by standard deviation, which is which gives me extra return per unit of risk I'm taking. So it's a risk-adjusted return. And then I compare sorted based on the Sharpe ratio, and then pick up funds which have done better in terms of Sharpe ratio. This also means that I'm assuming that historical practices or techniques, whatever fund manager has used it, will continue in future. But that is one of the assumptions which I need to write on. Other than that, I cannot analyze past to project a future. So that definitely remains one of the criteria. So risk adjusted return, which is a Sharpe ratio, that is the first one. Second is looking at last 5 calendar years, whether they have done better than the category or they have done lesser than the category. So first one, if you look at it, Mirae Asset TechSaver, in all 5 years they are above average of the category in all 5 years. Till the time there are 3 greens and 2 reds, we are fine. If it's deteriorating than that, out of last 5 calendar years, then we'll be little cautious. And third is the column of 3 and 5 year number, which we keep on monitoring. We don't look at any performance less than 3 years for any mutual funds, because it's meant for investment, it's not meant for trading. Some fund which have not done good over span of 3 years, then we try to understand why strategy has not worked, and then try to restructure the portfolio based on the other relative performances. So this was just one example. You can have your own process, and most of these numbers are in public domain. You go to Money Control, you go to Value Research, you go to Economic Times, many websites which are throwing good numbers, good analysis also. So, but decide a particular strategy and just keep on following that. I come across very often 5 mistakes, and that's what I highlighted over here. Investing without proper understanding. Unless you know the 6 factors which I mentioned at the beginning, and unless you relate your investment with these 6 factors or analyze from these 6 factors, it's I would consider as without proper understanding what you have invested. By fluke it can work well. By fluke you may have a extraordinary return, but that doesn't excite me at all, because I cannot replicate that same for my clients. For my clients, I generally ask them to go through all 6 factors and then decide where exactly you are investing into. So have a proper understanding of wherever you are investing into. It cannot be just my broker told me and I invested into this stock or this mutual fund. Second, timing the market is the mistake most of investors do it. Post-COVID, Nifty moved up from 7,000 level to 12,000 and a couple of my clients just exited as it is. They sold out everything because they were facing much tough time in their business, and they thought that markets also will recognize that. Instead of that, market non-stop have moved up from 12,000 Nifty level to 18,000 plus, and they have not been able to participate again. So rather than taking extreme decisions, let money grow. You just do the rebalancing. Don't try to time the market. Third is frequent reshuffling of funds. While rebalancing is a tool, but you need to do it not very often. Once in a year is good enough, because there is a cost in terms of your taxation and unnecessary hassles of writing and maintaining the accounts. So just leave it for longer than a year. Decide probably your birthday as a rebalancing day. If rebalancing is off by just 1 or 2 percentage points, don't tinker with that. If it's beyond 5, 7, 10 percentage here and there, then rebalance it, so you have some sizable action to take. Too many funds doesn't help. One particular scheme on an average would have at least 60 different instruments. No point of diversifying beyond 5, 6 different equity schemes, maybe maximum 7. Going beyond that, unnecessarily you're increasing your work without any advantage. And panic exit, as I was mentioning, post-COVID, many investors went out and they never came back. I keep on getting question about why PMS or why mutual fund, what is the advantage of one versus another. PMS is basically a tool to create a customized portfolio. Mutual fund is for masses, and even for HNIs, I still suggest mutual funds because there is no specific need to create a portfolio. If I am getting a particular taste and flavor and preference through a mutual fund, why do I need to get into PMS? It's much more cost effective, much more operational effective and tax effective for me. Then why do I need to go beyond mutual funds? So these are the factors which will once again suggest that in most of the cases, I'm not saying 100% of cases, but most of the cases probably PMS may not be the right solution just for the sake of getting associated with a particular brand. It doesn't make sense to get into PMS. Rather, mutual fund is giving me similar risk return profile, then why do I need to get into PMS? So there are a few factors which I have mentioned over here. Another question which keeps on coming up is ELSS versus PPF. Whether should I invest into PPF or whether should I invest into ELSS? And despite whatever factors I have mentioned, my simple strategy is do SIP of PPF. 6,500 rupee every month is better rather than thinking about markets have moved up, why should I get into ELSS? Let me get into PPF. And next year, once again, you will question whether did I make the right decision or market has moved up despite I have invested into PPF. What is the advantage? So keep on investing into PPF only to the extent of whatever you want to invest. But for the tax purpose, if you are investing, then give us enough priority to ELSS and do it through SIP so that your timing is kind of averaged out. The last point which I wanted to mention was, as I had earlier mentioned briefly, fixed deposits, which people find very comfort. Though in India, rarely a bank would have gone belly up, but globally banks also go bankrupt very easily, especially in US. So we have comfort in terms of that my bank is sound and I'm having enough or rather enough comfort by staying into bank fixed deposits or corporate fixed deposit. But compared to that, you have tax advantage when you invest into fixed income mutual funds, debt mutual funds, and the tax advantage is 20% tax rate after indexation, which comes to around 7 to 8% tax rate. Compared to your bank FD, what you are paying, almost 1/3 of your tax rate. So the investors which are in 30% plus tax bracket and one who doesn't need cash flow, because here we are assuming that we are going with the growth option, so capital gain. With growth option, debt mutual funds, high quality one, becomes much more better solution compared to your traditional investment of bank FD or corporate FDs. So these are the post yield comparison what I have shown it at current moment, and it can keep on changing from time to time. But in most of the cases, at most of the times in markets, debt mutual funds at that point of time could be better than your bank FD or corporate FDs for someone who is into 30% tax bracket. So that's all from my side. I'll be glad to take questions. The last few slides, I just wanted to highlight a couple of questions which I keep on getting. If you have any questions in that context, I'll be glad to address those. I hope I'm within my schedule.
Sir, I started my career after 35 years, in CA. And I could not make money like many people do at 20s. I started making money only at the age of 40s. I started investing slowly in FDs, then I moved to equity, then I moved to SIPs, as you rightly told. Maybe 20 to 30% of my salary is being invested. In the case of SIPs, I have not decided the fund. It will be like my friends or the people who I know, who I think they are experts, because I'm a compliance person, not a money-making person. So in this case, if somebody tells me, okay, you invest in this, I will definitely do it. Right now, I started thinking where to invest it. Where my money, is it going to, it has to be like a good growth, or is it to be my in return of income? So I don't have the passion to study also, actually speaking. I like to earn money, I like to see the slides, but when reality comes, I don't invest my time in studying the markets. So as a person who wants to make money, where to invest actually? Is it a growth or the return? Can you please advise? Second question I have is, I am doing a SIP. What is the difference between SIP and systematic withdrawal plan? You told there is a small portion of capital gain only will be there. Does it mean the indexation is helping me, or really my cash flow is reducing to that extent? I wanted to know that. Third one is the timing or the duration. Will it be like 3 years, 5 years? As a normal investor, can you please advise that, sir?
I never thought 3 questions will come in a row. Fine. So if I missed out any point, please let me know. So first question was about which schemes and how do I study that, right? Whether SIP, if I'm doing anyone suggesting whether it's good or not. Second is difference between SIP and SWP. And third was, fine. For any investment, fine. So the first one is which schemes, SIP, anyone suggesting that? I think over a period of time you will gain confidence about why a particular person is suggesting a particular scheme. So for that, before gaining and that confidence, or before trusting a person, you need to question him just to understand his rationale or intention. When you go and pick up anything from provision store, you just don't pick it up, right? You look at what is there on its ingredients, or what is there its offering when it's manufactured, and so on and so forth, right? Same way over here, why do you need to just blindly trust anyone? It's your own hard-earned money. And from that perspective, as I said, there are many websites which is giving enough data. And from that, at least you look at a couple of factors, including what is the size of AUM. So you know that it's not something which is very small size, and people don't, other investors are not trusting, then why should you trust? So you should at least go with some decent size, something like 1,000 crore plus AUM, any particular scheme. So while we select, we do set up different categories, different AUM criteria. Based on that only we select a particular scheme. Second is how consistent the fund manager in that scheme is. If it's very oftenly changed, then that's not good for the strategy for that what they are playing out. Third is in terms of historical performance, but that could be just one criteria. And fourth is the category itself. A particular category is suggested by anyone, and if it's they'll show you the historical return, you invest in that, there could be accident over there. The reason I'll tell you, example. 2007, rather 2005, 6, 7, every year, infrastructure thematic funds were giving something like 35 to 40% return. And based on that, whoever invested into 2008, then it's a very miserable situation after that. So the point I'm making is category is very important. You need to decide about whether you want to get into kind of steady state categories or little aggressive ones. So sectoral thematic comes into aggressive ones. They are real aggressive ones. Mid cap, small cap comes in that. Compared to that, flexi cap and large cap would be relatively lower risk in that. So if you want to study further, look at the standard deviation. How much is the standard deviation of this particular scheme vis-a-vis any other scheme or even for that category. And all this data is in public domain. Look at Value Research, look at Money Control, please look at Economic Times and many other websites. There are many such websites will throw all these numbers. So it's your hard-earned money. You need to invest some time before you make any investment decisions. SIP is just the vehicle. You said you had invested into FD, then equity, and then SIP. SIP is the vehicle through which you can invest into fixed income mutual funds also, and you can invest into equity mutual funds also, you can invest into hybrid mutual funds also. So equity, when you are categorizing separately, I am assuming you are talking about direct equity stocks, which I will not suggest if you are not getting enough time to study about. Rather, you invest into index fund where you are participating in all 30 or all 50 stocks, and the index company itself, which is kind of owned by NSE or BSE, they themselves reshuffle it every 6 months. If some new stocks is doing good and based on market cap it's of the higher size, they will add that, and something not performing, they weed it out. So something like Tata Motors to Bombay Dyeing to Levers, and many stocks have gone out and a few of them have come back also. So the point I'm making is, if something is not performing, then index fund itself is a dynamic concept. It's not just a buy and forget kind of concept. So you can invest into index fund for that purpose if you want to maintain your expense ratio low and you don't get time to review it, rather than getting into any actively managed scheme per se. Second, SIP and SWP are exactly opposite. SIP is for investing money, SWP is for withdrawing money. Few people after retirement or senior citizens, they need regular cash flow, and that's where SWP helps. And that's where, rather than investing into bank FDs where it's a higher taxation in terms of full tax income from other sources, over here you can plan it and structure in such a way that your cash flow comes back at the lower tax rate. And lower tax rate is because of 20% tax on fixed income mutual fund with indexation. So automatically your tax rate will drop significantly after 3 years. But you need to plan it in such a way that first 3 years you are not withdrawing so much amount. Third year onwards, keep on withdrawing with a lower tax based on your need. So that's about SIP and SWP. Something parallel to SIP is STP, which is systematic transfer and systematic investment. Both are parallel. One is meant for salaried class, one is meant for professional and businessmen. That is the only relation. Ultimately, all three are vehicles to either invest or to withdraw it, right? Destination could be anything. It could be equity schemes or debt schemes, as I clarified earlier. Duration, how long you should invest? You should invest perpetually. If you withdraw money from your equity schemes and fixed income schemes, I question where would you invest in future? Because these are the only products meant for your life. What is the reason of withdrawing 100%? I fail to understand. What you need to do it is keep on rebalancing it. So you're doing some profit booking at the higher level, you're buying again at the lower level. Rebalancing is the only solution. Again, another point to be noted is, generally for an investor, every 5 years their profile changes. As my age progresses, I will tend to have a lower risk tolerance or risk taking capacities. So if I'm starting with 70 equity, 30 debt at a younger age, gradually I'll move to 30-70, 30 equity and 70 over a period of time. And that depends on many other circumstances besides my earning capability and my family situation, my future cash requirement or cash flow commitments, and so on and so forth. So from that perspective, any investment, be it even for that purpose, bank FD to your mutual fund to your direct stocks, everything has to be perpetual. What is the point of innovating some new product just for the sake of it? If my existing products are meeting my requirements, there is no need to just be inventor and create new products just for the sake of it. There is no need. So I think duration should be perpetual. Keep on rebalancing it. Only when you need cash flow, then only you touch your investments. Unnecessarily churning portfolio results into your tax implication, and that much money goes out, which will not create further compounding on that amount. That's all. Thanks. If I missed out anything, I'll be glad to clarify that.
Sir, thanks to you because wonderful presentation of these slides.
Thanks.
Kudos to you for making this mutual fund subject, otherwise very well known and a very common subject. But you have put it's a very lively knowledge for all of us. Thanks for that.
Thanks.
And in fact, your lecture, and I was just seeing your slides. So very, very useful. Although we know all these things, but it added to our knowledge.
Thanks.
My two questions. First is, say suppose I may or I may not have an SIP. Say today I got a 10 lakh rupees and I just want to invest lump sum in a mutual fund. Now the market is going up, the share market is going up and has just touched the highest. So which is the proper time to invest that lump sum amount? That is first thing, because I'm just watching the market is not going down to create opportunities for the buying of the say shares or the mutual fund as well. So which is the best time? Should the investor wait for a particular opportunity for investing that lump sum amount? That is the first question. Second is, in your opinion, as on today, which is the best fund that a common investor can put his money in the mutual fund? Because as such, we don't have a technical knowledge. Technical analysis, charting and all these things, we are generally common man doesn't know. So all these things can be done by the fund managers. So which is the fund you can, in your knowledge, in your thinking, is the best one?
Fair enough. Fine. So thanks for your good words, kind words. First about SIP, 10 lakh, timing the lump sum amount. So I'll go back to my experience. Index Nifty moved up from 7,000 level to 12,000, and a couple of my clients liquidated and they have not yet come back. And definitely business situation, that point of time was very tough during post-COVID time, post-lockdown. And one was always worried about market can further correct, and I'll probably get once again opportunity to reinvest at 7,000 Nifty level, but never happened. From 12,000 to non-stop, it has moved to 18,000 plus Nifty levels. And it's a decent, by any means, it's a decent rally in last post-COVID, post-lockdown time. So from that perspective, I will never suggest to time the market. That is the cardinal concept. Second is it also depends on your cash flow. 10 lakh you said you have it now. How often are you going to get 10 lakhs again to reinvest? So if you are making 10 lakhs every month, which could be reality, 10 lakhs every month, if you can invest it, it becomes an SIP itself. Keep on investing 10 lakhs. Don't try to time it. Because 10 lakh itself, whatever X amount is, if you are investing every month, the market itself will take care of it in terms of levels of market, and accordingly units will be allotted. So if markets have gone up, lower number of units will be allotted. If market has gone down, more number of units will be allotted. So better to do it systematically. Now the question is, if I'm investing 10 lakhs now, and assume it I'm not generating cash flow surplus from my business or salary or whatever every month 10 lakh rupees, then what do I do? If that is the question, then the second question pertaining to that is, are you going to make further 10 lakhs investable surplus through some other sources in next 6 months? Then divide this 10 lakhs for next 6 months as an entry point. Further 10 lakhs which comes in, divide for further 6 months, and so on and so forth. So that is what exactly I was meaning. I meant when I said X and Y amount. If you are getting X amount right now, which you know that within next 6 months I'm going to get Y amount, divide X by 6 right now, invest into next 6 months. Y amount you get it, and you know Z amount you will get it after 12 months. Divide Y amount into 12 installments and then wait for Z cash flow to come in, and then keep on staggering it out. So idea is that you need to spread it out. No one knows the market. Please don't try to time the market, and keep on spreading it out will give you better entry points. Otherwise, I've seen during correction, people keep on waiting for further correction, never happens. So better to spread it out. That is the solution. For that, STP is the solution rather than SIP. Put into liquid fund. From liquid fund, it will go into equity funds in a staggered manner. Second point over here, when we are saying 10 lakh rupee, we assume it to be all equity funds. I would rather go to the extent, even do the asset allocation over there, put in your fixed income investments also in that same proportion, so your allocation remains constant. So your allocation can remain in your strategic allocation proportion consistently. So that is about second point. Third, which fund to invest? You need to decide about what kind of risk tolerance you have it and what kind of time horizon you have it. If you have a average risk tolerance capacity and you want to invest some portion in your equity for the future growth, go with index fund. There are almost all fund houses, at least large ones, they have a Nifty index fund, which is a low cost vehicle. Invest into that. If you want to be little more aggressive, don't try to be get into actively managed funds if you are not able to study it. Get into mid cap and small cap index fund as well. There are mid cap and small cap indices and funds related to that. You participate through that. But please note that mid cap and small cap has a much higher risk compared to your large cap. So try to spread out your investments based on your risk tolerance, your investment horizon, and your study or understanding about it.
Hello.
Haji.
Like sir mentioned that someone have lump sum amount of 10 lakh and also having a home loan. So is it better to pre-close the home loan or invest in mutual fund?
So when it comes to investment, I generally put a word investable surplus. Some component of a home loan could be better because you get some advantage of whatever 2 lakh rupee a year as an interest on housing loan. So to that extent, you can play around with that. But generally, investable surplus are meant for after clearing all your liabilities. So some kind of mix and match you can do it, but not aggressive investments when you have a liabilities in front of you. Please don't do that. Otherwise, at times you may need to sell off at wrong time your investment just to cover up your liabilities. Yeah, please. Please come again. Index fund.
Index fund is normally give the same return with the index, or it will be give better or lower return?
Marginally lower to the extent of expense ratio. Marginally lower, because most of these index funds will have a expense ratio attached to it because they need to manage it. And nowadays the index is considered as a TRI, which is total return index. Earlier used to be absolute return, so your dividend was not considered over there. When you now consider dividend, the underlying portfolio also has a dividend, so both are at par. But additionally, this index fund will have a one expense ratio, and second, some kind of tracking error. Because of reshuffling, whatever in and out keeps on happening, they may not get the exact quantity. So there could be somewhat little variation in that. So it would be few bips lower performance possibility.
We can say 99% accurate.
99 point something compared to the index
Nifty
fund
or
return
BSE.
itself. Yeah.
Okay, thank you, sir.
Thanks. Haji, Haji.
Good afternoon, sir.
Good afternoon, sir.
Sir, my two questions is there. That one thing that you say that offline and online both are available to
Haji.
invest. Whether there is any return deviation in case of online and offline.
Sorry, come again. What is that?
If I invest through offline,
Haji.
whether I get less return compared to online.
No. Okay.
So that's that agent commission and all. Whether
Okay. So as I said, one is called direct plan, another is called regular plan. Direct plan will have no agent commission. The expense ratio would be lower. To that extent, yeah, return would be better. But you need to manage yourself. So you need to go to website of such mutual funds and then do on your own. When you do it through your distributors, you have a couple of other advantages in terms of logistics pertaining to or after sale service in that sense. But in that you will have a higher expense ratio, and accordingly your return to that extent would be lower, which would be few bips to 100 bips at times. It could be little more also, but in somewhere over there. So definitely online offline will not have any difference. Only difference would be between direct and regular plan for your return perspective. Yeah.
And second thing that recently we have heard about that Axis Mutual Fund manager
Front running,
and Franklin Temptation. How it is how SEBI is doing to stop all this thing, because fund manager are something they have all the required knowledge about the stocks, particular stock, when they are going to invest and all. They can tap that in an other way around.
So if you look at Axis front running case at this moment, or even earlier, a couple of other fund houses, including HDFC Mutual Fund, had a front running incident. When you look at the detailed report, SEBI has printed in verbatim the conversation happened on their mobiles. So SEBI has an access to all the data points. Besides, forget about your relatives' transactions happening, which is very well mapped to for all these important people in the fund management team, right? That's already mapped. Even your conversations are being tapped. So now, prima facie, what has been mentioned in the report is that because of COVID, transactions were happening not from office but from outside also, because it was work from home. So immediately SEBI has stopped that. Asked everyone, not only for fund management team, even for the relationship managers and everyone, to work from office only. So, and there are certain protocols or restrictions in terms of you have access control, you cannot get into dealing room, you cannot get out of dealing room, you cannot have a mobile from dealing room, and so on and so forth. So every conversations are through the recorded lines. So many restrictions have come in. Having said that, Indian minds are, human minds are intelligent ones. They will try to find some loophole out of the system, and which most of us try to do it. So I cannot be 100% sure, but the way SEBI has controlled and regulated over span of last couple of years, hats off to them that this system has not failed during COVID times as well, first. And second, your size has grown from 10 trillion to 40 trillion and no major accidents. Somewhere some intentionally do it to play around with the system. You can't control 100% in any way. But SEBI is doing enough to do it. In fact, at times, be it on this side or this side, I also get frustrated with the compliance which is taking up time. And the way you guys also busy with all compliance and all deadlines. I'm sure fund managers are also much more getting involved in the compliances. So I think everyone is trying to put right rules and put the boundaries to the rules, but still somewhere something can happen. I can't deny that.
My point is whether we can check AUM part when we decide that
So nowadays analytics are much more vibrant than what would have been earlier, and people keep on doing that, but it's not so easy. Just to give an example, in India you get monthly detailed portfolio reports, right? So you know underlying in terms of quantity every month end for all fund houses by 10th of the month. Globally, people don't do it. People don't get it. People have only quarterly disclosure requirements. So from that perspective, we are much better off. But now within a month, if they would have bought and sold something, done some front running, you will not come to know because it's not in a public domain. So then I think market is much more intelligent. By grapevine and hearsay, you will come to know where the leakages are happening.
Hi.
Haji,
I have very simple two questions. Recently, a lot of SDL, like closed maturity funds, are coming, and naturally, parallelly, government also pushing retail participant in a bond market.
Haji.
There were naturally government RBI come up with its own platform where retail investor can buy, sell bond.
Fantastic.
And along with that, Bharat bond, which is a third round just close by.
Yeah.
How do you differentiate these three, activity or rather three opportunity to invest vis-a-vis? Aren't they anti each other?
So one is about target maturity funds like SDL. Second, you are referring to Bharat bond, and third, you are referring to RBI owned sub-ledger accounts, right? First two are relevant, third one is not. So SDL and Bharat bond, because of the mutual fund platform, they get the benefit of 20% taxation with indexation, which if you are investing into RBI bonds yourself, whatever, 10,000 rupee onwards, you will not get that benefit. So you will be fully paying tax on that. And over and above that, if you are getting into RBI savings bond, which is a 6-7 years of lock-in, it's further difficult to get out. So from that perspective, I think SDL and Bharat Bond within the category of target maturity funds is still better than the other options at this moment. Fine. Thanks, Ratan.